Thank you, Massimo, and welcome back from lunch. So there are two challenges, I think, of being the first presenter after lunch. The first of those challenges is that you've got to try to piece together all the bits of the morning session and cut out the bits that they've already taken. And the second is that I've got to try and keep you awake. Hopefully you've had some of the delicious local coffee, which will help with that. So Massimo has very kindly introduced me briefly. I'm a partner at EY based in London. I run EY's global investment advisory services. So I spend a lot of time on the road working with companies all around Europe and the rest of the world. And my level of interest in this topic has grown significantly in the last year and has grown a lot in the last few years. And my personal interest has been there for some time, but the level of engagement from my clients has recently significantly picked up. And I'm going to talk you through some of those themes today. Now, before I go into my special numbers, I'm also going to warn you that given that it's a post-lunch session, I am going to expect a little bit of audience participation. So core to my topic is going to be 4 hypotheses, which I'm going to set out to prove or disprove. And before I do that, I'm going to ask the audience in the old-fashioned way to vote whether they agree in advance with my hypotheses before I get there. Okay. So start with my 3 special numbers. The first thing to say about my 3 special numbers is that they are all taken from my personal life, which I hope says something about the relative importance that I place on my personal life over my professional life, notwithstanding the wonderful organisation that I belong to, and having spent 15 years there, home life remains very important. So I'll start with 12, which is simply the number of years that I've been married to my wife. And as a young trainee actuary with significantly more hair than I have today, she clearly assessed my proposition in a long-term value session by considering somebody whose looks were certainly going to fade, but hopefully with some sustainable and socially sound values. We are still married, so it's working okay so far. My numbers 9 and 10 represent the age of my 2 daughters. These are important as they represent 2 critical points. The first is one that I share with Michele, which is that my wife and I were prepared to sacrifice some short-term pain for long-term gain in having our 2 children, in my case, 12 months apart. And anybody that either has children or has children close together will understand the challenges of having 2 children, 0 and 1 years old. And the secondly is that I'm an actuary by training, and I can say that they should have a long life ahead of them, and one in which a sustainable world will be far more likely if we can align the capital markets with the political and social world. And there's been an undercurrent of that throughout everything that we talked about this morning, but I'm hopefully going to bring some of that to life. So on to my talk and the hypotheses. So I started out by thinking about what I'd like to try to be able to discuss with this audience, which is, can you generate alpha and minimize beta through ESG? And we've heard quite a lot about that this morning. But I've drawn on 3 studies that we've done at EY and 1 study performed by Fidelity Institutional to try to make my cases. And these are the 4 hypotheses that I want to cover with you this afternoon. The first is that the market is not yet pricing in COP21. The second that you've heard a lot about this morning, which is that long-term value is broader than financial value. The third, I'm going to use the term sin stocks because it's a bit of a mouthful to say stocks which some people exclude from their portfolio. So I'm going to use the term sin stocks. It also helps with a little bit of provocation. But they've outperformed in the past, but will not outperform in the future. And the fourth is that E, S, and G are equally important for long-term value differentiators. And by the end, I'm going to use these hypotheses to try to answer whether we can differentiate to generate alpha and minimize beta through ESG. So let's start with COP21. This is the first part of the audience participation. Can you please put up your hand if you agree with the hypothesis that the market is not yet pricing in the impact of COP21? Interesting. A split room. Okay. I wonder if some of you are abstaining, but we shall see whether by the end of the presentation we can get to a little bit more consensus. So, last year we did some analysis with Oxford Economics, which is a leading economics forecaster based in the UK. It works on global trends. And one of its key differentiators is that it uses the UK government's own forecasting mechanism. And what we wanted to do was to examine what the market is pricing in within equities, government bonds, consumer price inflation, and corporate bonds. And so the first chart on this slide shows the prices of each, with a baseline at 100 of 2007, rolls us forward through the financial crisis, and then projects forward up until 2032. Now, the thing with economists is that they don't know when crashes are going to happen, and most of them would tell you that it's highly unlikely that we will not have a crash between now and 2032. But on average, what they will project from this point forward is a benign projection. And whilst this slide is showing some projections in the UK market, they would have similar sorts of projections for other markets in Europe and the rest of the world. So our view is that the market appears to be pricing in the fact that no global policies are enforced. And so action has got to be led by the private sector. Low carbon price is consistent with historic trend. And I'll then set out what these baseline projections mean for us in our projections in terms of policy, technology, weather conditions, and investors' view. And whilst I set these out, I'd like you to think about how these assumptions could not be true. So in terms of policy, major polluters, for example, China and India, do not meet their intended nationally determined contributions. No additional climate change regulation is put in place on a global level. Level of international coordination is low. I mean, these are slightly stark statements, but if these were not true, we think that we would see more differentiation in equity prices and international valuations premia from one country to another, or subsidies valued within prices of, for example, renewable stocks. In terms of technology, carbon intensity of the energy sector continues on the same trend as it is today. There are no major technology developments in the short term, and there's a slow trend towards adoption of electric storage technology. And similar to the above, we would expect if that was not true, that you'd see more of a differentiation between unclean energy and subsidies within renewables. Though perhaps this is a bit harder, as even the older energy-type companies are now starting to invest a bit in new emerging greener technology. What about weather? Very topical this year. Extreme weather events continue at their current level of frequency. Crop yields, water scarcity, disease prevalence, and deforestation follow the current trend. And again, if these were not true, then we should be seeing a change in the cost of insurance. We should see a reversal in the exodus that we've seen out of the insurance-linked securities market this year, where investors are starting to not see the value in the yields that they had seen in catastrophe bonds in the past. And we'd also see a prevalence of more preventative techniques that we don't yet see. And in terms of the investor's view, then the importance of ESG continues to increase. So we do see a continuation of some of the trends that we've seen previously. Green bonds continue to be issued at the same trend, with new countries entering the market, like Ireland did, I think the fourth country to enter the green bond market earlier on this year. But what's really important, and I think the clearest to see from an investor's perspective, is that the market does not appear to be pricing in any shocks. We remain really bullish on all fronts, equities, government bonds, and inflation, with no evidence of a shock. And that suggests a continuation of the current adoption, continuation of the current trends that will ultimately end up with that sort of, as economists see it, that benign view. But I think that is a very unsustainable way of thinking about the market. And so when we did these projections, we considered three different scenarios which seem far more likely to us, and thought about what that would do to a carbon-intense stock. And that's what we've plotted on the bottom chart. So we start off on the left-hand side just plotting what's happened to equities, in this case on a baseline, and then we look at what might happen in these scenarios. And what I've plotted up here is what we call a delayed action scenario. And the delayed action suggests that we get big policy initiative that triggers a massive investment post-2025, so very much later than we're currently expecting. We get the highest carbon price post-2025 of all of our scenarios, so it's a wait and then a big shock. You could end up with a forced transition, so post-2021, you end up with a sudden shift, with aggressive policy action, and then you get a high carbon price, not quite as high as the 2025 scenario. Or we looked at a gradual transition, so one where you get a gradual shift in policy after 2019 and a medium carbon price thereafter. So this slide reminds me of that famous Warren Buffett quote, which is that we tend to underestimate the impact of change over a 10-year period, but we tend to overestimate the impact of change over 1 year. So certainly in my role, I go around talking to CIOs, and they're all worried about shocks over the next year, which could be very likely. But I think it's very difficult to see how this sort of shock doesn't bear out for carbon-intense stocks. Because if we head out towards 2032, in this scenario, you get a delayed uptake in change of policy, but you get something akin to a carbon tax post-2025 because it's the only way to reverse where you've got to at that point. And then out towards 2032, we then start to see technological advances such as renewables, battery storage, which will take advantage of the subsidies that must be introduced in order to reverse where we've got to at that point. And I would put it to you that all of our scenarios, which we consider everything other than just not implementing COP21, which we think is just too unfathomable, shows a hit in carbon-intense stocks compared to today's prices. And all our different scenarios are considering is whether that starts to hit in 2019, 2021, 2025, or some later time. So, considering the theme of my presentation, I would suggest that the evidence points to an ability to differentiate between stocks based on carbon intensity and remove potential volatility through considering the impact of different scenarios. And that no plausible scenarios today show that the market has priced in the impact of COP21. Having heard what I've had to say, when we come to questions at the end, I'd be very interested to hear from some people that do think that the market is priced in COP21, where the flaws are in the argument that I've put towards you today. And before I leave this slide, I'd like to reference an article in this week's Economist, which warns of the compromise that we've already made by accepting a 2-degree world. So all of our scenarios was based on a 2-degree world being the baseline. We looked at worse scenarios, but we didn't look at anything that involved a faster implementation. But the article references a study of 6,000 pieces of literature, the most stark being that a 1.5-degree world requires a complete removal of all of the 42 gigatons of CO2 in annual emission, taking renewable energy from 25% to 75% intensity by 2050. And the threat, therefore, of a delayed action where we wait until the middle of the next decade to implement the paradigm shift required to create a sustainable planet looks a real one, particularly for investors evaluating relative value and risks. So having depressed you with my views on COP21, I might try and lift us up a little bit by thinking about how we might be able to tackle some of these challenges today. And I want to build on these considerations by broadening the argument beyond carbon and climate change. So EY has sponsored an initiative called the Embankment Project for Inclusive Capitalism, which a number of you in the room are familiar with. It's brought together over 30 blue-chip companies managing more than $28 trillion of assets globally, including asset creators, asset managers, and asset owners. And it considers a number of hypotheses which centre on the fact that outcome metrics are insightful measures of long-term value, but that disclosure at the moment is an issue despite the fact that we have a lot more information than is publicly available. So, before I go on to some of my analysis, I'd like to invite some audience participation again, and I think we might get a bit more consensus this time. I'd like you to put up your hand if you agree that long-term value is broader than financial value. Okay. And can you put up your hand if you think that long-term value is not broader than financial value? Okay. So we've got still a large number of abstainers, but perhaps fewer naysayers than we had in the last poll. Sorry, I'm also going backwards. So this first slide sets out a schematic of the way that we and organisations within the Embankment Project have agreed to consider long-term value, and it's considering a lot of the same sorts of themes that you've heard about earlier on today. And outcome metrics sit right in the centre of the schematic and are used to measure the achievement of the stakeholder outcomes. So think about some of the stakeholder outcomes of boards and things that we heard this morning, and think of outcome metrics being a way to be able to measure those. And all of this is set within a framework of context, purpose, strategy, and governance of an organisation which determine these outcomes. And in an environment where the trust gap between businesses, the establishment, and society is widening. So given our topic today, I'd like to particularly consider the value creation, or alpha, and value protection, or I'm going to call that beta. Because alpha and beta are relevant here when considering one organisation against another. So moving on to my next slide. We found that long-term value creators and protectors consider a lot more than financial value. The third slide in this section will consider how little financial value makes up a share price today, a stat which we've already heard about earlier on today. But before we get there, let's think about three other measures of long-term value that we think about, which pull together some of the different measures of capital that we heard about earlier on today. So consumer value. It seems clear today that certain stocks get this. If you think about Apple and Facebook, they get the value of interacting with consumers. And our expectation is that this will have to be the case for more traditional brands. And I think that's a real threat to financial services, because if you're a fintech company or insurtech company and you set out to try to create consumer value, you're starting from a blank canvas, and you're going to perhaps find that easier than some of the big financial services organisations that have got things they've got to undo before they can start doing. But those with a strong brand and consumer focus will be the winners and should differentiate against their consumers, their competitors. The next one, which we've heard about this morning, is human value. And the example I wanted to draw out here was Google, because I think that's probably the exemplar in this regard. It's traditionally used time for what it calls blue sky thinking to maximise the use and the value that it gets from every single person within that organisation. And one of the things that I really love about my organisation is that we have a similar concept to breed innovation and maximise value creation through people. So all of our staff are contractually required to work 35 hours or 40 hours, however many it may be per country. But of those, we're only required on average to spend 22 of those out with clients, being paid by clients. The residual time is spent to do some of the admin, but that's a few hours. And the rest of the time is to develop new ideas, to go and create innovation. And I think that's a key part of human value. But societal value, I think we've heard consistently this morning that this remains a challenge, but we are starting to see this in action more on downward pressure. So a number of my clients have had really tough AGMs this year, even compared to last year, through challenge from activist investors, a number of high-profile insurance companies this includes, particularly around climate change. But we should start to see that widen, because it has an impact. If it disrupts your AGM, you can't spend time talking to your investors about why these results are so wonderful and this new product is really wonderful, and instead you have to defend why you've chosen to invest in a particular stock or you've chosen to insure a particular industry, then nobody at the board level or at management is going to want that. So we will see threats to share prices and increasing differentiation through investors' views of company societal value. And if I look at best in class here, then some of my private equity clients, they have an ESG stream where they think about value of companies, and they think about the upsides and the downsides of companies in a very systematic way. They've got their own measures, but they think about those as being differentiators of value, and I think that's going to become much more mainstream. And then some numbers. So I like this slide because it puts some of the numbers and some of the history behind the 20% statistic that you heard earlier on today. And it separates the value of a company between its tangible assets and its intangible assets. And I think there's two really interesting things. One is that it has changed so dramatically from 1975, where it was almost entirely based on tangible assets, to now only 20% being based on that. But also that it's still increasing, and on a relative basis, it's increased 18% since 2011. So some other numbers which I couldn't squeeze into this slide. Less than half of the general public trust businesses, down from 2017 in the Edelman Trust Barometer. And the most commonly cited challenge to this trust in business is not operating in an open and transparent way, which I think talks to some of the themes we heard this morning. And 60% believe that CEOs should be leading the charge rather than waiting for regulators to impose it. And again, I think that's in contrast to some of the board behaviours that were responded by boards in the last session just before lunch. But let's stick with the regulatory theme for a moment, because we heard earlier on from our colleague from EVAS about some of the changes that EVAS is putting through. We heard earlier on about the French regulation, which has mandated in law the requirement to disclose climate, how you're investing as it regards to climate change. EIOPA has been invited to consider its response to the European Commission's new package of sustainability measures in July of this year, and in particular to embed the sustainability goals in insurers' investment decision-making. And implementing enhanced disclosures at the moment seems to be the most likely way of dealing with this. That will deal with the openness and transparency that I talked about a minute ago. But there are some considerations of not necessarily making the capital charges lower for high ESG stocks, but making the capital charges higher for low ESG scoring stocks. And there is precedent for this. If we think about how Europe tackled securitizations, which it determined were not good assets for insurance companies to deal with, then they imposed very high capital charges. And we could potentially see high capital charges for some stocks which are really considered non-core. And yesterday, the UK regulator, the PRA, issued a consultation paper to UK insurers and banks, which are around very, very similar lines, but their proposals are calling for enhanced disclosure, as well as governance and risk analysis. So in conclusion, I hope that this sort of analysis helps us to understand that long-term value will only increase in focus as regulators and analysts move away from traditional financial-only metrics. Okay, on to sin stocks. Now, I think this is possibly my most controversial hypothesis. When I speak to CIOs, the most commonly cited challenge for not having a more ESG-aware investment framework is that if they had done so in the past, they would have underperformed. So depending on your measure, if you go back long enough, then if you exclude certain sectors which have clearly done very well in the past, carbon-dominated sectors, even weapons sectors, you will find that excluding stocks will drag performance. And if you're a CIO and your primary objective is to make money on the investments of your company, that's a really difficult way, that's a very difficult thing to turn a blind eye to. But I think there's some good reasons to suggest that whilst they've outperformed in the past, they won't necessarily do so in the future. So I'm going to ask for a straw poll again, and would the audience please mind indicating if you agree with the hypothesis that sin stocks have outperformed in the past but will not do so in the future? Okay, some tentative hands. And those of you who disagree with the hypothesis? Interesting. A larger number of abstainers, so that either means that I've managed to bore a larger proportion of the audience into sleep, or it means that they are genuinely sitting on the fence. I'm going to back myself and go with the second of those statements for now. But both of my slides in this section consider reproduce graphs from what I think is a really excellent Fidelity Institutional article, ESG and Performance in 7 graphs, and it considers a number of challenges in ESG, but looks at actual studies and data underlying them. So first of all, I wanted to use their sectoral view, which considers an ESG portfolio against a reference portfolio stocks. And ESG here is being represented by the Dow Jones Sustainability Index, and the wider stocks are 809 randomly chosen equities, and the time period in consideration is 2014 to 2016. So when I looked at this, and I did have to look at this a few times, there's a few takeaways that I had from this slide. So firstly, backing up my CIO's concerns, there are sectors where the reference portfolio performs better. Sadly for me, insurance was one of those. Banking, unfortunately, continuing within the financial services theme, is the same. Durables and automobiles, again, perhaps unsurprising, though again, automobiles, you kind of wonder whether the Tesla success story might have been a bit of a pull to some of the newer thinking automobiles. Secondly, there are some which the ESG portfolio performs better, and probably the most surprising in there was energy, because again, if I think about energy, then as things stand at the moment, it's not obvious that 2014 to 2016 was the right period to have seen a change in the way that stocks performances had started to behave, but perhaps there was sign of a change at that point. So overall in this period, the ESG index performs better from a total returns perspective, but also from a volatility perspective, which we've not shown, but which lots of people have referenced earlier on today. But the challenge is that stock selector is going to have to work really hard, because there's still 4 out of those sectors which did not perform so well. And you're going to have to work really hard in order to work out how to generate alpha from a sectoral perspective. But the beta is probably a bit more compelling, because given that you've got some divergences between sector, where you are now not getting such a one-way position such that the non-excluded portfolios are performing better than the excluded portfolios, surely the additional risk that you're going to take from having stocks with poor ESG scores are not commensurate with higher returns. It's too patchy a picture. And I think that hypothesis should only get stronger if you think about some of the changes that are coming down the pipe. So that's a sectoral view where I think I can just about make the case for beta, but I'm finding it harder to make the case for alpha. If I look at conduct, though, it perhaps tells us that we've been maybe considering the wrong analysis. So this is a really nice piece of analysis which was performed on a Norwegian sovereign wealth fund's portfolio. It's got $1 trillion worth of investments and over 10% of the world's equities, so it's a pretty relevant statistic. And there's also analysis which is very similar to this by Sustainalytics and MSCI, which show returns on their ESG indices, which are very consistent with what we see from this one sovereign wealth fund. And what it does is it shows that if you take conduct-based exclusions rather than sectoral-based exclusions, which is arguably much more aligned to ESG and a stronger positive indicator than products and sectors, this seems to show compelling evidence that conduct is a powerful alpha indicator. Certainly if you look at the top part of this graph, where you can see the total conduct-based exclusions adds up to a positive number. And again, it's very difficult to believe why that wouldn't be the case going forwards. But one of the consistent challenges we've heard all morning, and that I hear from my CIOs and the risk people that we deal with, is the ability to measure the risks in the stocks. So the analysis presented here on conduct is necessarily subjective. But as we move to a world of better disclosure and better analytics, as I described in my previous hypothesis, we will be able to much more accurately measure on a going forward basis the behaviour between different stocks. But critically, it'll also be easier for investors to make a choice. If I'm a retail investor and I want to go and invest in something, I could go and invest in a so-called ethical fund or an ESG fund, but it might be more extreme than the view that I want to take. It's a series of packaged products today. But if there's a lot of disclosure out there about different types of stocks, I can make my own decisions. And so it's not just institutions that will be able to shift the move towards higher ESG scoring and lower ESG scoring stocks. But one of the potential challenges remains consistent reporting. And this is something that we worked really hard on for Solvency II for insurance companies, where we developed as an industry the so-called tripartite template, which transmits data from asset managers to insurance companies in a consistent way. It's a horrible template for anybody that's ever had to fill it in, but it is much better the alternative, which is that everybody comes up with their own views. And I'm really pleased to say that there's a working group meeting later on this week to discuss a similar template for insurance companies reporting under Solvency II for ESG factors. And it's based on what has already been embedded and tested very well in the French market. And that could start to move us towards consistent reporting in the insurance industry, could permeate into the asset management industry, and hopefully a bit more broadly. And hearing some of the talks today, it seems that they'll probably have to join up with some of the existing organisations which are already making great strides in that space. So in summary, for this hypothesis, I think I'm going to agree with the audience that I don't think there's quite enough data today to conclude without doubt. But I think that there is evidence that in some cases, so-called sin stocks underperform. And I would certainly argue for a CIO that the additional beta, the additional downside risk, is not obviously commensurate with the additional returns that appear to be available now in the so-called sin stocks. And so the lower risk option ought to be to invest in an ESG compliant manner. I'm conscious of time, so I will spend less time on my fourth hypothesis. Okay, final straw poll, and quickly. ESG are equally important long-term value differentiators. Who agrees with that hypothesis? And who disagrees? Okay, super. A split audience again. So I'm not going to go into too much detail given time. This is the result of a benchmarking study we performed across a number of publicly listed companies where we assessed them across 7 measures in the table. And if we start off just looking at the bottom row, which is on resourcing, we assigned a score of 5 to firms that had a disclosed responsible investment team of greater than 4 people, a score of 3 for those who've got a team of 1 to 2, and a score of 1 with less than 1 FTE, and a score of 0 if they have none. So all 13 said that they had somebody who was responsible for responsible investing, but the vast majority had less than 1 FTE. It was part of a broader role that they had within the organisation, with only 1 company having a team of more than 4. And if we then look up the columns, you can see that those which are amber or green in the bottom row tend to score a bit better on some of the other measures. So responsible investment strategy, responsible investment governance, communication and reporting. Just to pick out some of the real challenges when we looked at everybody, we found that quantitative disclosure on how the evolution of a company's responsible investment policy has affected its investment portfolio is really rare. We'd really like to see some positive statements about we might have invested in this, but we chose not to for these reasons. It's inconsistent with our policy. There's very little disclosure in that sort of space. We found that international companies were more prepared from a regulatory perspective than those which were purely local. And we found that all of the surveyed companies participate in initiatives on climate change disclosure, but very few of them have incorporated them in their customer propositions. So I think if I cut to the chase on what this analysis shows, I think it shows that there's a wide divergence of uptake in responsible investment, and certainly in the way that people disclose responsible investment. And so you should be able to see significant differentiation from one to another when you look at the way that they disclose these items. Slightly more troubling as somebody that works in the insurance sector, I think there's something also here that says that if you look at the way that insurers are, and I don't here mean the top 10 biggest global insurance companies, I mean your average mid-market listed insurance company in a local market, we are lagging behind asset managers. And so that might mean that insurance company stocks get picked off as opposed to asset management stocks. So I'm going to close out with my conclusions, which don't necessarily agree with the audience participation. But I think there's evidence that the market is not pricing in COP21, and even further, it's not pricing in the more extreme changes that we might need to prevent irreversible changes to our planet. Secondly, I really hope that everybody today agrees that long-term value is broader than financial value. You've got to be able to take into account some of the things that you've heard about today, and we've got to be able to measure it. I think sin stocks have historically outperformed, and they might not do in the future. And on the balance, if I was a CIO, I would be betting against the sin stocks. And governance has always been a value indicator. You get people like GENERALI, you heard earlier on today, and Elliott, which will go and they will actively take positions on boards to drive out changes in governance. We're starting to get much clearer position on environment. And at the moment, my personal belief is that while social relies on impact investing, it's not clear that you're going to generate positive performance in the short term, but we do expect it to do so in the longer term. And with that, I will close and ask if you've got